This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Trevor Garvin from Net Group Investments Multi-Manager. Today's voice note is entitled, Markets Remain Volatile as Energy Shocks and Geopolitics Continue to Dominate the Narrative. It has been a busy past week in terms of news headlines. President Ramaphosa remains under a lot of pressure due to the Phala Phala scandal. Parliament is now looking to set up an impeachment committee as instructed by the courts. The country is also recovering from devastating storms which caused severe flooding and damage in certain areas and many people stranded. President Trump had a fleeting 2-day trip to China, which the world was watching closely, and Manchester City edged out Chelsea to win the British FA Cup. Markets are once again being driven primarily by geopolitics, energy prices, and the knock-on effects for inflation and interest rate expectations. And importantly, the past week reinforced just how sensitive markets remain to those dynamics. The JSE All-Share Index is currently sitting around the 114,000 level, down roughly 3.6% over the past week, reflecting global risk-off sentiment and weaker commodity prices. From a broader perspective, the local market is still up about 23% over the past year, but has softened in recent weeks as global volatility has increased. On the economic and policy front, rising fuel costs remain a key concern for South Africa, with expectations building for another fuel price increase in June, reinforcing the inflation sensitivity of the domestic economy. Turning to global markets, the key theme remains the Middle East conflict and the ongoing disruptions in the Strait of Hormuz. While there have been intermittent hopes of de-escalation, the reality is that shipping flows remain constrained and markets are continuing to price a meaningful risk premium into energy markets. This is critical because the Strait typically accounts for roughly 20% of global oil trade, meaning even partial disruption has a disproportionate impact on prices and global inflation expectations. We saw this play out again over the past week, with oil prices remaining elevated and volatile. Brent crude is currently trading just above $110 per barrel, having risen meaningfully over the past month and remaining highly sensitive to any geopolitical headlines. At the start of the week, US President Donald Trump's rejection of Iran's proposals to end the war and reopen the Strait of Hormuz lifted oil prices. The International Energy Agency has warned that the world is heading for the worst oil supply shock in history as inventories plunge at the fastest pace on record. Gold continues to reflect this uncertainty, holding at very elevated levels, currently around $4,550 per ounce, albeit slightly softer on the day. In equities, US markets remain close to record highs, but have started to show some signs of fatigue. The S&P 500 is trading around 7,400, having reached new highs last week before pulling back slightly as energy prices and bond yields increased. Bond markets have reacted accordingly. The US Treasury yields have moved higher, with the 10-year yield around the mid-4.5% range after rising over the past week on renewed inflation concerns. The South African 10-year bond yields are sitting at approximately 8.8%, reflecting both attractive real yields and ongoing sensitivity to global inflation shocks. In currencies, the rand has weakened modestly and is currently trading at around 16.70 rand to the US dollar, reflecting the stronger dollar environment and ongoing global risk aversion. The rand also weakened due to global investors being cautious ahead of the high-stakes meeting between Donald Trump and Xi Jinping. The president and Chinese leader had a fruitful 2 days of meetings. The British pound fell to its lowest level in 2 weeks as pressure mounted on Prime Minister Keir Starmer to resign after the Labour Party's poor showing in the local government elections. Investors fretted about the implications of a change in government spending for fiscal plans. It is clear to see that there is still a lot of uncertainty in the world, and equity market volatility is on the increase. Investors need to be patient and stick to one's long-term investment plan. Till next time, with thanks, Trevor.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.